Hello, everyone. Good day to you. Jacob Chaparro here, along with my colleague, Pablo. This is Zenith's monthly market update, and we're excited to bring you 4 high-level topics in which we'll go over some market news, some indicators, how the market's performing, and other major indices. There's definitely some winners, some laggers, as well as touching on a couple of things, personal finance, so that hopefully this update not only provides you some insight, but also something that's applicable where you can actually apply it to your own wealth. And we will actually end the conversation with talking about the proposed tax plan that the new administration rolled out. So without further ado, we'll kind of jump into it. Hey, Pablo, how's it going today?
Very good. Thank you, Jacob. How are you doing?
I'm all right. I actually have been in the Phoenix area for the past 6 months. And this past weekend, we came home finally to sunny San Diego. So I'm all smiles.
That's very good. We love to be there. San Diego is always a very nice city.
Not too shabby. I definitely chase the sun. Growing up in Phoenix and obviously Southern California, which actually in May gets a little cloudy for those that haven't been there. But anyhow, Pablo, we have some really good discussions to talk about in our market update this month. And I know one of the things that's been front in mind, just because of where we're at within the year and the quarter, has been quarterly earnings. So most of the companies that are within the S&P 500 have reported, I think to be exact, 76% of them. We'll take a look here. But, a couple of things here for our viewers to know is where we stand with that and why it's important. Why are earnings important to understand? And there's so many things we can put into this, Pablo, but what would you say would be some of the 1 or 2 things of why it's important and to really understand and pay attention to quarterly earnings season?
Well, definitely it's important because this is what drives the performance of the stock market, basically. For instance, in the last year, the return of the Standard & Poor's 500, it was 60%. Amazing. Is great. And why that is important to you? Because the growth of your IRA, your 401k, your investment accounts is highly correlated with the performance of the stock market. For instance, how is doing the U.S. economy? Well, the most recent reading indicates that the economy grew 7% in the last quarter. So why is it important to you? Because if your business or the company where you work are doing better, the economy is growing, so that's going to be better for you. It's going to be
That's right.
good for everyone, basically. For instance, another indicator what it kind of measure that the economy is in an expansion, the Pma Index. The last reading was 60. Unemployment. Remember, after the lockdown, the unemployment reached to 15%. That's a lot of people that were out of work. Today, the last reading is 6. So that's amazing. What
more than half.
Yeah. The flexibility of the American economy.
And one thing to put things into retrospect and put it into perspective, truly, when we talk about unemployment, one of these indicators that is one we always look at, to put it in perspective, typically we should operate around 4% plus or minus 1 unemployment rate. That's almost ideal, right? According to economists and the Federal Reserve, in fact. And to go from 4, where we're at pre-COVID, or close to it, right? I think we're around 5.
Yeah.
5 to 15, that is a lot of people. 10% of our population, you can do the numbers. That's a lot of people that aren't working. And why that's significant is because when people aren't working, they're not producing income. And if they're not producing income, they're not spending. And that right here is a big premise as to why our economy grows and expands. Is our GDP, our gross domestic product, is in fact a big weighting of it, of how much money we simply spend. So when we don't have folks working and they're not spending, it really puts a crutch on our entire economy. And therefore, other corporations that are obviously trying to make money, and you take that one step further, this is important because, going back to Pablo's point, if these corporations aren't making money, whether directly or indirectly, these companies are probably owned in your IRA, in your 401k, in your brokerage account. So to circle back to, understanding what companies are doing, and every quarter they report how they're doing, is extremely important because it gives us an idea of how healthy our economy is. It maybe gives us a little bit of a glimpse of what to expect, of how the market moves. And I think specifically, it should give you a sense of how your specific accounts should start to fluctuate, go up, go down, whatever it is. It's some expectation into it. So I think to understand what that looks like on a quarterly basis is time well spent. That's for sure.
That's right. Yeah. And it's important. This is, everything is going very well. However, you notice that there is a discussion of inflation. Some people are saying that inflation is coming, no? And the question is, the risk of inflation is real. So, well, so far, not that much. For instance, the PCE index, which is the preferred measure of inflation of the Federal Reserve, is below the target of 2% annual inflation of the Fed. So far, we are okay. So basically, in summary, it's like the stock market is doing well, the economy is doing well, the unemployment is coming down. So it's not surprising that the confidence of the consumer is at an all-time high, basically.
Exactly. And you start to hear this word a little bit, maybe not as big yet to the common and average American, is this euphoric type of expectation, right? And demeanor when we're investing. But just to go back to earnings, I have the numbers here that so far as of today, 361 companies out of the 500 in the Standard & Poor's have reported, and 86% of them are beating the estimates. So you talk about a world really quick before we transition into how we're doing from a number standpoint, because I think that's pretty important for our viewers to understand, is where we're at year to date, how well we've done, how poor we've done. But before we go into that, when we go back to understanding that 86% of the companies that reported earnings have beat their expectation, what that truly means is companies are making more money than the experts or analysts were expecting them to. In fact, almost 90% of them. So that's important because you look at a world where 12 months ago, we were in the eye of the storm with the pandemic and COVID-19, and these companies were able to innovate and to pivot to ultimately produce returns for their company and therefore their investors. It's kind of, I don't want to get ahead of myself, but it's a little bit of an exciting time because how companies were able to pivot through this pandemic. And as we start to see vaccinations coming through, COVID cases going down, hospitalization rates going down, you really start to think to yourself, wow, if we were able to do pretty well through this pandemic, and these companies are reporting really good numbers, inflation is okay, Pablo mentioned unemployment, then you have to ask yourself, where are we going here? So that's hopefully what we'll touch on here. But Pablo, why don't we transition and talk about, how we've done year to date, how the major indices have done, where specifically within the market, once you peel the layers a little bit, specific sectors, which ones are doing well, which ones are lagging. Can you touch on that for us?
That for sure. And again, we continue with good news, basically. If, for instance, the S&P 500, year to date, the return has been almost 13%. So remember this number, because if the asset classes score a high return, that means that they are outperforming the market. If those asset classes score a lower return than 13%, are underperforming the market. For instance, let's go to value and growth style. There is a lot of conversation. Okay, who is winning basically? Well, so far, year to date, value is winning almost with 15% return, compared with growth only almost 10%. However, it's important to mention that in the last 5 years, growth has outperformed value greatly. So, but so far, year to date is winning value.
Small, and if I could just interject, so we keep everyone here in the loop. When you hear about these types of companies, you hear them being value-oriented stocks, growth-oriented stocks, and really a big distinguishment there is value companies typically tend to produce a dividend, tend to not over leverage as much. Growth companies typically don't pay a dividend. They really inject their profits into their company to progress them. A good example would be a good dividend-paying value company, utility companies. AT&T is probably one of the bigger value companies out there, right? Financials,
energy.
Growth companies, you think of companies like mostly tech companies, right?
Correct.
Where they're just putting in everything, so they're moving their stock forward. So sorry to interrupt, Pablo, just want to make sure we understand the difference between value and growth. And to your point, growth companies have outpaced value stocks greatly the past 5 years, like you were saying.
Totally. And for instance, when also we compare a small cap and mid cap. So small and mid cap is capitalization. So the Standard & Poor's 500 is a large cap index. But this is small cap, so the return has been very similar. So both have outperformed the general market between 16 and 15% both. And one thing that you mentioned before, it's good to be in the US. It's good to be part of the US economy. For instance, the international market or emerging market, they have underperformed the US market. The return is around 8-7%. So this is keep on that in mind, because it's very important. Yeah. And then when we go to sectors, Jacob, so for instance, what was your favorite sector at the beginning of the year? So January 1st, 2021.
Yeah. You know, if I could, I'll go back really to one thing you said, and just an observation, hopefully a little bit of wisdom here. Oftentimes we see when we're comparing our domestic markets to international markets, emerging markets, oftentimes the US is always the leader and everyone kind of follows suit. So I think what's likely to happen, just based on historical trends, Pablo mentioned emerging markets right now are 7-8%, right? Something like that year to date. We're doubling that at 13%. So here's one thing, and a takeaway, food for thought for our listeners and our viewers is, at some point in time, everything starts to alter. So you may want to start, even though emerging markets are lagging right now and the world is kind of getting out of this pandemic slump, it's likely that once our economies start to kind of cool down a little bit, someone's going to pick up the pace. And where I would look at as an investor is what's been lagging, and specifically the emerging market space, because those are the countries that don't have as much resources as the US or developed countries like Germany and France. So they tend to lag a little bit. Big opportunity, ultimately, is what I'm saying. In our opinion, in emerging markets, at some point in time later in the year, keep an eye on that if you're a trader and investor. So going back to your question, Pablo, what did I like heading into the year? I thought financials were kind of a shoo-in to really shine. They had been lagging last year. They were last really 2 years almost. And when you factor in the interest rate environment that we're in and how much they lag in comparison to other sectors, financials was kind of a shoo-in, for us. So What about you? Was there a specific sector, or did I steal your thunder a little bit?
No, that's totally fine. So I will just give you the data of the if you can call the four horses that they have been winning so far. Energy, 35%. Financial year to date, no, almost 26.
Yep.
Communication, 24, which here you have Google and Facebook in those sectors, important. And consumer discretionary, you have Amazon in almost 23%. One curiosity for me, at least, for instance, healthcare and consumer staples, no? Sector that they were open during the pandemic, they were essential for the government.
That's right.
They have totally underperformed. For me, that was amazing. And lastly, bonds. And why bonds are important? Because if you're, it's a source of income if you're a retiree, and also provide capital protection in your portfolio. That's the main value of bonds. Unfortunately, only high yield bonds have generated a positive return, around 1.5. The others index, like the AGG, is very famous, Barclays aggregate index, negative. Long duration bonds, very negative. Investment grade corporate, very negative. So anyways, we can move to the next topic.
Yeah, and just to comment on that before we proceed, it's the observation you pointed out of healthcare, how it's lagging in comparison. If you looked at healthcare last year and tech last year, I believe those were the two top sectors in 2020.
Yeah.
And if you think about it, you kind of step back and try to just apply simple logic. Obviously, hospitals were going crazy. Pharmaceuticals were going crazy trying to get drugs out, materials out. So there's a lot of movement in the healthcare sector because of the need with the pandemic. If you think about how the year progressed with us staying at home and working and innovating, Zoom, right, is a perfect example. That stock exploded because of the need of that specific technology in order to operate our daily lives. So even right now, yesterday, the NASDAQ tech stocks started to sell off a little bit when you're comparing what's taking place so far this year in comparison to last year. Healthcare is cooled off a little bit, and you start to see a shift into other sectors like financials, like energy that's been lagging, and that's the fun in it. There's a saying out there that goes something along the lines of something is always making money, regardless of what the economy is doing.
Totally.
And it's such a great quest to be on, and understanding that. And if you're trading, if you're an investor, you're viewing this, I hope you feel the same, because something is making money all the time. It's just trying to find what that is. Hopefully our videos can help you, enlighten you in your research. So go ahead, Pablo.
And I forgot to ask you one question, so because we are CNET investment management, and I was going to ask you which are kind of our preferred sectors, or which are the asset classes that we have some positive view for the next month.
Yeah, I like the question, and by no means take this as a recommendation, just to give her a quick plug, right? This is just our own personal take. Definitely consult with a professional before you invest. I think financials have a good runway. When you talk about, which we'll get to here shortly, the administration's new plan to invest in infrastructure, those stocks there have a lot of upside. And you have to ask yourself that question too when you invest. What is my upside? What is my downside? Technology is really one of those sectors where you kind of start to question a little bit, what the downside is to that, just because of how much it's gone up. Now, technology, I think, is always going to be performing, but it is going to be more volatile, and that's a dynamic in which you as an investor or trader want to take into consideration based on what you're trying to accomplish. Is the volatility of a certain sector or certain company. Right now, tech has exploded and it's starting to cool off a little bit. So the question that you should ask yourself is, what's my downside here? when you take into consideration financials that have been lagging, energy, which has been lagging, and now they're exploding, well, now you have a little bit lower potentially downside. The upside's higher. So that's a different dynamic in which you want to take into consideration. We'll finish off here our episode with talking about the Biden tax plan. Hopefully throughout the episode, we're giving you personal finance tips and perspective to apply. So why don't we finish the conversation off, Pablo, if you want to lead us into just the overall high-level understanding of what the new administration plan is, and a couple of things in which we want to point out that hopefully translate into protecting and growing your wealth.
Well, definitely. So, which is the Biden plan? That's kind of it's a almost $4 trillion plan. It has two parts. One is the infrastructure plan. It's around 2.3 trillion. Basically, they're going to help with affordable housing. So that's important to our listeners, because that's going to help you to have more disposable income. Buying houses is one of the most expensive parts of, or paying rent is the most expensive part. So this is important. High-speed broadband. They're going to invest in high-speed broadband. That's going to help also for your disposable income, because you won't have to live in crowded or very expensive city. You can move to other part of the country. They will build better roads, bridges. They will invest in helping corporations to have a higher productivity. And that eventually will help with higher salaries for their employees, because they're planning to invest in supply chain support, domestic manufacturing. So all this is important. The other part of the plan is they're planning to spend $1.8 trillion in the next 10 years for families, basically. And that's going to be tax credits, which again is going to increase your disposable income for those who qualify for this tax credit, of course. Also, they're going to provide child and family support, child care, family medical leave. Also, they're going to provide more money for education, like a free universal preschool. Community college is going to be free for the first 2 years. So that's going to help to get more education, more money in the future, better earnings for employees.
Definitely. And there's a lot of opportunity there, right? In terms of understanding, where this money is going to go to, and essentially what sector, and then what underlying companies are going to get that money to then perform what they do best and turn a profit. There's a lot of gold in the graph that we just showed you here to understand not just what to expect our administration, but we're talking about investing, where you can find opportunities so that you can apply your knowledge and wisdom into what you potentially think, right? This money ultimately is going to go to infrastructure, right? The industrial stocks. Still with healthcare, there's still with COVID, there's still a lot of stuff going on, even though healthcare is lagging. One sector, one of the questions you had for me, Pablo, and this is kind of my second sector that I'm intrigued about, is energy and how much it's been beaten down. And I'm really curious to observe how the energy sector performs throughout the summer. It's one of the best sectors so far in 2021. And you piece little things together, such as, the travel industry starting to open up. I just traveled, was in the airport, I think 2 weeks ago, and it was amazing how many more people there were when I traveled 3 months ago. So when you talk about people wanting to get out and travel and being able to do so, especially in our country, where people are starting to get vaccinated, right? COVID-19 isn't so much of a worry. Travel season begins in summer, typically, and that means a lot of consumption in terms of energy and fuel. So that's intriguing to me to see how that continues to progress. But Pablo, is there any other talking points that you want to bring up before we sign off here?
Well, very short, it's important the excess of savings that there is in the U.S. economy, or that the U.S. economy has accumulated since 2020. It's almost 1.6 trillion, and this is important because some of these savings, it will go to traveling, restaurant, but the other part is going to go to the markets, no? Because the stock market is the best driver of economic wealth. For instance, if you have invested $10,000 in April 2001, today you will have 40,000, almost 4 times, if you consider a 2% annual dividend. So it's just amazing, and you just have to put the money there. So this is something important. So which, related with that, what do you recommend to people who has excess of savings?
Yeah, I actually had this conversation yesterday with a client, and excellent savers, they have done a great job to do that. In fact, too well, because too much savings can actually hinder your wealth. And not to get technical, but if we really aren't making what the inflation rate is in this example, we're at like 2% right now, Pablo. Is that right?
Yeah.
Inflation currently?
Yep.
If we're not making 2%, yeah, then we're really taking a step back, because it's all about purchasing power. Quick example, a gallon of milk today costs $4, whatever it is. You go back to 2001, a gallon of milk is costing you $2, right? A carton of eggs cost $1 back then. Now it's like $4. So your purchasing power is extremely important to take into consideration, not just presently, but in the future. So if you have too much savings, if you're looking to understand, hey, where should I put this? Please note that, ask yourself the question of what you have to get, not what you need, because if you don't understand and take into account that you need to make at least the inflation, you're taking a step back. Some of the things that we discussed in terms of cash savings, and for risk adverse individuals, there are many creative things out there, maybe not so creative, but a CD ladder. If you don't know what that is, definitely talk to your advisor. We're happy to discuss that with you. Please reach out to us, or just Google what a CD ladder is. That way it provides you that much more interest. It provides you still some liquidity. The other thing we talked about yesterday with these clients was municipal bonds. The big challenge with cash is whatever you invest into it, assuming it's not going to go to your IRA or 401k, it's going to be in a brokerage account. You have to take into consideration the tax perspective of it, because you're going to have to likely pay taxes every year. So if you don't know much about municipal bonds, that could be a really, really great weapon for you to get a lot of your true return back and tax-free, triple tax exempt, depending on where you buy these bonds, if it's in your state or where you file taxes. So those are two quick little things. Look at CD ladders, look at municipal bonds. To Pablo's point, it's proven that even though volatile times exist, the stock market's a very powerful tool, regardless if it's energy or technology, whatever it is, right? Just investing in the market in general can be your biggest factor, and not so much trying to time it, but just put time into the market, be patient. I think most of the time people of wealth find out that their patience pays off by simply just adding to the market, especially when you have opportunities like last year where the market sells off. So that's what's key, to talk to an advisor about understanding when to take risks, when to not. What percentage of return do you need in order to accomplish what you're seeking? Because that's a very different dynamic. And I think that's where any good advisor, I know that's what we do, is taking the market fluctuations out of the equation. And we only use the stock market to get to what we want to, opposed to riding the market. Our clients understand what they need, what we want to accomplish, and we use the stock market, but we don't let it dictate our plans there. So Pablo, why don't we leave it at that? I know we can probably discuss things so much more. So we'll catch our viewers next month with another market update. Thank you guys for watching. Pablo, any last words?
No, thank you so much. And again, if someone wants to write, if they want to share some, or they want to more information regarding any subject, we will be happy to do some research. We're here to help, basically.
That's right. Feel free to leave comments. If there's something that you want us to discuss, we're happy to do so. Send us a message, look us up. Everyone have a great rest of the month. Take care.
Thank you.